Are we about to see the next wave of bank failures? The FDIC just reported that we had another 11 banks move into the category of seriously troubled banks, and they've issued a report to outline exactly what the stability of the banking system looks like. In this video, I'm going to give you my opinion along with this data on how concerned you need to be about this banking crisis, and the next one, well, that's brewing. Let's get started. So first, this is the FDIC quarterly banking profile for the first quarter. So it's for Q1. Now there's something really important to know about this being from the first quarter. It's that unfortunately things are going to get worse before they get better. See, most of these banks have issues, or the ones that do have issues because they have portfolios of bonds on their bank balance sheets. Okay, fancy way of basically saying they have a bag of stuff that's worth less than it used to be worth. That means you have a lot of banks that are sitting on a lot of unrealized losses, which means they haven't sold that bag yet, but those are still losses, which unfortunately means some banks have less money than people might otherwise think they have, and especially with how accounting rules work, not all of those actually have to show up on the balance sheet, mark to market. And that's how you end up getting banking failures when, oopsie doopsie, more people are trying to get their money out of the bank, but you just can't get it out. Something similar is actually happening to not a bank right now, which is a company called Yotta Bank that has to do with one of their intermediaries going bankrupt, and that's really a topic for a different video. This video is about actual banks and a real banking crisis. So, the report tells us the following data that we really want to pay attention to. The first thing that makes me most nervous is this section right here. It's on page 2 of the report. Unrealized losses on available for sale and held to maturity securities increased $39 billion to $517 billion. That's an increase of about 7.5% in a quarter. That's not great. A 7.5% increase in a quarter is like a 30% increase in a year. So quarter sequentially, I like to write. That's from the fourth quarter to the first quarter. Yikes. And this is also the 9th straight quarter of unusually high unrealized losses since the Federal Reserve began to raise interest rates. So in other words, we're 9 times 4, we're now at 36 months into, 9 times 3, right? There we go. Each quarter is 3 months. We're now 27 months in a row into this crisis of losses going up at banks. Now, in addition to this, we get a note here that there's also been a notable increase in the level of write-downs on credit cards, and that the industry's quarterly net charge-off rate remained about 0.65% in the second quarter, but that's 25 basis points higher than it was last year. And the most important bottom line, in case a lot of that sounds noisy, it's the highest rate of charge-offs since the third quarter of 2011. But 2011 was like the second wave bottom, at least in the real estate market. That's kind of scary to compare to as you're coming out of the Great Recession. Not great. But then you've also got this right above chart number 14, which would put us at page, let's say it's 11. Yes, page 11 right here. Okay, the FDIC has a list of problem banks, and total assets held by problem banks just ballooned. It just exploded from $15.8 billion of risk to $82.1 billion of risk. That's a really big explosion in risk. That's a 5x increase in the total assets held by problem banks. That's not great. 5x. Now, when did this change? Well, it says here the number of banks on the list increased from 52 in the fourth quarter to 63 in the first quarter of 2024. So in one quarter, we had 11 more banks added to the list. And total assets held by problem banks increased 5x. That's the scary part. This 5x increase in problem banks, not good. Not good at all. Now, something you'll notice is if you actually do the math, you had about a 21% increase in the number of problem banks. That's going 52 to 63, right? That's about 21%. But it's worth noting there are 4,500 banks in America. So you really only went from 1.15% problem banks to 1.4% problem banks. And the FDIC says it's normal to have 1 to 2% of banks on the problem list. But what they don't mention is what a normal level of assets at risk is. Like, look, if you had 52 banks with $15.8 billion of problem money, or assets at those problem banks, that means each of the banks had an average balance of about $300 million. So 52 at 15.8 equals average of $303 million each problem bank. Enter. There we go. All right. But now that's actually risen substantially. So we're going to now change this math and we're going to do 63 banks. And the total assets of exposure here are about 82.1. So we 5x'd, which means all of a sudden the level of problem banks, or the average balance at each of these, has just exploded to $1.3 billion for each problem bank. Well, wait a second. That means what we just did is we just 4x'd the number of assets, or the average size. 4x'd average problem bank size. That's a little bit scary. Why is that scary? Well, look at the end of the report. Right here, they talk about how FDIC lost $22 billion from Signature Bank, and they have to recover that through other assessments on other banks. And they lost, let's see here, Signature Bank, yeah, that's all they show here. They don't show the other banks. Oh, I thought maybe they showed another bank here. Okay, that's okay. They lost $22.5 billion. There it is, for Silicon Valley Bank and Signature Bank. That was their total loss. So for those two banks, $22.5 billion loss. Well, the current problem is also about 4 times the loss that they had from Signature Bank and Silicon Valley Bank. So the current level 4, level 5 problem is 4x the size, even though it feels like we just went from 1.15 to 1.45. So what does that practically mean as a bottom line? Well, so a practical point of view is, I'm going to write this down. You ready for this? Annotate page. No more hikes. Okay? Practical point number 1, the Fed can't afford to create another banking crisis, because then they'll be forced to cut rates substantially more rapidly, and they could reintroduce inflation. So ironically, you start lowering interest rates, you create less stress on the banks, and you potentially solve inflation at the same time. Whereas you hike rates or keep rates high too long, you create more stress on the banks, create a crisis. Now you have to cut rates substantially, and then, oh no, you might have to reverse because all of a sudden inflation is rising again. So I think this practically screams no more hikes, and if anything, it probably means you want to get life insurance by going to metkevin.com/life. Sign up in as little as 5 minutes. Apple Pay, Android Pay for it. metkevin.com/life. It's a paid promoter of the channel. Check them out. It's what it's what Lauren and I use. metkevin.com/life. But it also practically probably means, honestly, reports like this, sooner rate cuts, which sort of now makes sense why JPOW seems like he's sort of been brushing off hot data, or sort of like warmer data, and it feels like he's been looking for a reason to cut. This might be why he's looking for a reason to cut. That's a little unfortunate. Now, well, is it unfortunate though? Maybe not. Maybe it's a good thing because equities are supported by that. Anyway, we're currently pricing in 1.8 rate cuts for December, and we are pricing in our first full rate cut the 2 days after the election. We only have about an 80% chance of a rate cut by September. So anyway, a little bit on the banking crisis, and are things getting worse? just 4 times worse in the quarter over quarter.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than Househack, nor am I presently acting as a market maker. Make sure if you're considering investing in Househack to always read the PPM at househack.com.